Thank you very much for joining us today. My name is Corey Daharsh, and I'm here with today's educational webinar on how to tap into your retirement capital, specifically strategies for real estate investing. So this is going to be a pretty basic 101 real estate investing webinar. Again, my name is Corey Daharsh. I've been with Advanta IRA since 2016. I've spent a number of years on our client account management team, handling transactions on a day-to-day basis and answering clients' questions about different strategies and different ways to invest their retirement dollars in alternative assets. And I now serve in the role on the business development team where I network and educate how you can use these accounts outside of real estate investing into other asset classes as well. But again, today's webinar is going to focus on the real estate investing assets specifically and different strategies. All my contact information is here. You can reach out to me one-to-one if you have any questions or would like to set up a complimentary consultation to go over your strategies and your intentions. I can definitely walk you through what plan type would fit best for you, what strategies would work or would not work with what you're trying to accomplish based on the IRS's rules I'm going to talk about today, and really anything else self-directed investing related. I do want to let you know as an audience that you are going to be muted for the duration of my presentation today, but I do want to encourage participation. So if you look at the GoToWebinar panel that should be on your screen, there's a little box called questions. Go ahead and type those in there. I have the questions box up on a separate screen, and I'll be answering those as I go, as long as they relate to what I'm speaking about in the moment, or if not, I've got a slide at the end of the presentation where I'll go over any miscellaneous questions that may come up. So please feel free to actively participate. I would love to answer your questions and make sure I'm covering everything thoroughly that you're here to learn about. So my agenda for today is this. I'm going to cover the basics of Advanta IRA and self-directed investing. I'm going to go into some rules for real estate investing, strategies for real estate investing, including private lending, and then a few case studies on different ways that you can utilize retirement funds for real estate aligned investments. Then after that, we'll wrap up and do a Q&A session if necessary, as I just referenced on the last slide. But let's keep it going here. Advanta IRA is a self-directed administrator. We've been in business for over 20 years now. We've got a little bit over $3 billion in assets under administration, about 13,000 active clients, and all of our clients' funds that are not actively invested are insured with FDIC institutions, so that money is safe, sitting idle, ready for your next deal. And when you are ready for that deal, all you really need to do is reach out to your client account manager, which we pair each client with, so that you can explain what you're trying to invest into or even provide the paperwork, make it a very smooth and simple process to execute your self-directed investments. Again, I served as a client account manager for about 5 years. You end up building continuity and rapport with your account manager over time so that it's not like a big call center where you have to explain who you are and what you're trying to do each time you reach out to utilize this account. That person will end up understanding what you're looking for or exactly how to answer your questions and how to assist you based on your needs and your specific intentions and goals. So it's really great. We pride ourselves in our customer service and this educational content you're here for today. So really hope that if you're not already a client of ours, you strongly consider it moving forward as well if you're going to do self-directed investing. A brief disclaimer. I am here to provide educational content. Everything I'm here to talk about is strictly educationally based. I've got case studies and examples, but they are rounded numbers and kind of just an example of what you could do with these types of accounts. We always implore you to consult your own team of CPAs, tax preparers, accountants, financial advisors. We're not here in a capacity to provide any fiduciary responsibilities or financial advising, tax advising, legal advising. That's all up to you as a self-directed investor to build and connect with your own team and make sure you're doing thorough due diligence before you transact in any specific investments. So what is a self-directed IRA? Simply put, it's a retirement account, just as you might have with a fiduciary or a financial advisor, Edward Jones, T. Rowe Price, Merrill Lynch, any of those other companies, that you're allowed to invest into anything you'd like to within the IRS's rules and regulations, meaning Advanta is not here to say, oh, we won't let you make that investment. We allow anything that the IRS allows. whereas a fiduciary or financial advisor company are going to limit you to assets that they've done underwriting and due diligence on, which are typically publicly traded stocks, bonds, mutual funds, those types of asset classes. So whether you're looking to completely switch over to self-direction or even just diversify some of your funds into a self-directed asset, that is why you would need a company like Advanta IRA if you're going to invest into real estate or some of the other alternative asset classes that a fiduciary does not allow for. Some of those asset classes, again, private lending, so mortgages or promissory notes, private placements, which do fall under the real estate asset class, precious metals, cryptocurrency, and a lot of different things. We cover a lot of different topics on these educational webinars, and I'm going to cover specifically the IRS's rules a little bit later to give you a more broad scope picture of what you really have the power to invest into with these types of accounts. So we do offer a number of different plan types. As I mentioned at the top of the webinar, if you have a conversation with me, I can definitely point you in the right direction of what plan type is going to fit your needs best. But just a general outline, traditional and Roth IRAs, most people are familiar with. If you maybe inherited a traditional or Roth IRA from someone that passed away and left that to you, that can be self-directed. Health savings and education savings accounts can be self-directed. So if you're someone with a high deductible health policy, you have an HSA account, you can switch that over and self-direct those funds. Or small business owners or self-employed individuals have a great utilized tool, the solo 401k, the SEP IRA, and the simple IRA. They have much higher annual contribution limits than your traditional Roth IRA, but they do require you have a sponsoring entity, business, or even sole proprietorship that you're utilizing to set up the plan to support. So again, let me know if you have any questions about those plan types. I can definitely learn a little bit more about your situation and scenario and point you in the direction of the best plan type fitting for your needs. So people choose to self-direct for a number of different reasons. First and foremost being that they find out that self-direction is even an option, and it becomes a new source of capital for investment strategies that they may have already been participating in, just not knowing that they could also use their retirement dollars in those types of transactions. A lot of people are starting to get fatigued with the stock market, and like I said, either choose to diversify and self-direct some of their retirement funds, or even maybe move the whole thing because they look at their statement at a fiduciary custodian and see more negatives than positives. So if that be the case, moving to self-direction may be a good option for you. And then the tax benefit of making these investments through your retirement account are that you're generating either tax deferred or tax-free income, depending if you have a traditional or a Roth account. So there's great benefits there. There are some handoffs in the real estate space, which I'll talk about a little bit later, but that is a baseline of why people choose to self-direct. I do want to address real quickly, I just saw someone use the hands raised feature on the Go to Webinar tab. I'm not able to see who it is specifically raising your hand, so please utilize the questions box. If you have a question, go ahead and type it in there. I've got it up on a separate screen, and I'll be happy to answer or address those as I go. Again, as long as they're relating to what I'm speaking about. If it's not related, I will answer those at the end in a questions kind of Q&A session after the presentation concludes today. So moving funds into these types of accounts are actually very, very simple. There's a big misnomer out there that this takes a lot of time, or it's tedious, or it triggers a taxable event for you. And I'm here on these next two slides to kind of break that all down very simple for you. Most people fund these accounts with what's called a custodian to custodian transfer, meaning you have an IRA, whether it's a traditional, a Roth, an inherited, a SEP, a simple, and you want to move that into a self-directed IRA. All you do is complete a transfer request form with the company you'd like to receive the money, Advanta IRA, an example, and we submit that to the company currently holding your money, and those funds are usually processed as a transfer within roughly a week or so. Some custodians can do it in 3 to 5 days. Some custodians take a little bit longer. My job when I'm speaking with someone and helping them get their account set up, or your account manager's job, if you have an existing account and want to move more money into it, is to basically give you a good timeline on what our notes say that other company takes as a timeline to get these accounts funded. Again, It really depends on what the protocol is from the company that's currently holding the money, sending it over. So as soon as I know what name you're working with, I or your account manager can give you a good estimate and a good timeline for what it's going to take to get that money moved over. The other way to fund these accounts are via rollover. What a rollover is when you have an employer-sponsored plan like a 401k, a 403b, a thrift savings plan, any type of employer-sponsored plan that you'd like to pull money from and move it into a self-direct account. Now, in most cases, you're allowed to move funds out of a previous employer plan, meaning you've terminated employment, however you want to, whenever you want to, as frequently or infrequently as you want to. But sometimes you're also allowed to move funds out of a current employer-sponsored plan. The difference there is when it's a current employer, you will have to verify that your retirement company that the employer is using and the employer have agreed in their plan agreement to allow for what's called in-service rollover. So if you're currently employed and you want to tap into some of that money in that plan for self-directed investing, you'll have to make sure you're eligible for an in-service rollover. A lot of times in-service rollover eligibility is based off of your current age. Sometimes they say you have to reach 59 and a half, which is legal retirement age. Sometimes they say you have to have been with the company for a certain tenure, like 10 years, 15 years, whatever it may be. That's always negotiated in the plan agreement between the retirement company and the employer. We have nothing to do or say about that. I can certainly help make that phone call to your benefits department or your employer retirement company to get that question answered, but it's as simple as verifying, am I eligible for in-service rollover or not? If not, when do I become eligible, if at all possible, without having to terminate employment? Now, when you're doing a rollover, it does trigger taxable reporting. So the distribution out of the current plan is reported to the IRS on Form 1099. What happens is as long as you're rolling that directly into another qualifying plan, that rollover in to the new company is reported on Form 5498, and there's no tax consequence as long as the exact money you pulled out is the exact amount you pushed into another qualifying plan. You can do this as frequently as you'd like to, both in times of doing rollovers and the quantity or dollar amount that you're rolling over. So again, with a transfer, it's non-taxable, non-reportable, one company's back office to the other. With a rollover, specifically a direct rollover I'm talking about here, where you're making the funds payable directly to your new retirement account, you can do that as often as you want. No taxable nature to place as long as the exact amounts pushed out is pulled into the new company. Now, one other way you can do a rollover is called an indirect rollover, sometimes called a 60-day bridge gap. What this is where you do a distribution out of an employer-sponsored plan, you make those funds payable to yourself, and you have what's called 60 days from constructive receipt to utilize those funds however you see fit, and then push ideally all, if not all, as much of the money as possible into a qualifying plan by the 60-day mark. And that is allowable once per rolling calendar year. So if you did it today, you'd have to wait until November 21st of 2025 before you're allowed to do another indirect rollover. And you have no tax consequence for that unless you're keeping a little bit behind. So let's say I distributed 50,000 and I rolled over 45,000 indirectly into a qualifying plan. I would have a tax consequence for $5,000, just to set the example there. Now we're going to rules and regulations about self-directed accounts. It's pretty simple, actually. Again, kind of like the account funding, there's a lot of misnomers out there that it's a lot of red tape and you can or cannot do this. Let me put it pretty simply for you. The IRS only restricts a few different assets from you to invest into. You're not allowed to invest into life insurance policies or hard to value collectibles like antiques, fine wine, artwork, anything that would be seen as having a subjective value. There are some coins that you're allowed to invest into. As you recall, I had precious metals up on that previous screen. So if you're interested in precious metal investing, you could reach out to me directly. But typically, currently circulating coins are not something you can invest into. It has to be like American Eagle, silver bullion, different things like that. The only other way that the IRS restricts what you or how you invest these accounts is by labeling certain individuals as disqualified persons. So you're not allowed to transact with disqualified persons, meaning I can't buy an asset from a disqualified person, or I can't let a disqualified person upgrade or enhance an asset held in my retirement account. That comes into play with real estate investing. Or I can't let a disqualified person benefit from an asset held in my retirement account, which again also comes into play with real estate investing. Those are the only ways the IRS restricts these accounts. So as long as you don't fall into a prohibited investment or a disqualified person situation, you can likely do whatever it is you're thinking about through your retirement funds. It just involves a conversation with myself or your client account manager to help iron out the strategy and the specifics. There are some little known taxes that may apply to certain investment scenarios. Unrelated business income tax is one of them. So in general, these accounts are set up to generate passive income, specifically passive income. But some investments may trigger active income. For example, if you use your retirement account to invest into a laundromat or a car wash, that may include having employees and is a functioning business. So depending on the way you structure that, UBIT or unrelated business income tax may apply, and that's something that's allowed. You just have to know that it applies in your investment scenario and make sure your CPA or tax preparer files and pays that UBIT through your retirement account. There's another tax called UDFI, unrelated debt financed income, that comes into play when you're utilizing your retirement funds on a leveraged investment. So I'm going to go buy a property in my retirement account, but I need to take out a loan to purchase it. The portion of the property that has leverage on it, so let's say I take out a loan for 40% of the property, I'm subject to UDFI tax through my retirement account for 40% of the total property. That is something I'm not going to cover too thoroughly today. We have our separate webinars that cover UBIT and UDFI tax, but if you have further questions about it, please feel free to let me know. I'm going to take a quick pause before I jump to the next slide. I see 2 questions listed here. The first one says, I have an LLC. I would like to get more info on a IRA so I can fund higher amounts into my retirement. I have a Vanguard account. So if you have an LLC and you're looking to set up a retirement account for that, you're likely going to fit best into a solo 401k plan. The nature of that is you need to make sure that you're generating income through the LLC, because to set up the solo 401k plan, you have to contribute earned income through that sponsoring entity to set up that plan. For that individual, please feel free to reach out to me directly. I'd be happy to have a further conversation with you about that and help you get fitted with the right plan type and explain to you the contribution limits and so forth. Second question that came in, allowed investment include Bitcoin, correct? Yes, you can invest into cryptocurrencies through your self-directed account. We have 1 or 2 crypto broker firms that work with us directly. Otherwise, a lot of clients utilize what's called checkbook LLCs. And when you have that checkbook LLC, you can then hold a cold storage wallet or invest into whatever brokerage for the cryptocurrency you'd like to in the name of the LLC. That's really a separate strategy and topic. So I'm not going to dive into that today. We're here to talk about real estate investing specifically. But again, for that individual as well, if you'd like to contact me directly one-to-one, we can definitely talk about cryptocurrency investing through a self-directed account. I can point you in the direction of some recent webinars we've done on that topic specifically as well. So a further illustration of disqualified persons. The disqualified persons list basically includes yourself, your spouse, your children, and your parents, and anyone on that main trunk of your family tree. So it also extends to any businesses that those individuals own or control 50% or more of, and or make day-to-day decisions on behalf of. So just to illustrate that a little bit further, I can't own a piece of property in my retirement account that I purchased from my father or his retirement account or my father's business. I can't buy a piece of property in the town I'm sending my child to school or college in and let my child be a tenant in that property. A few other examples here. I'm not going to read through every single one. I think you can get the gist of it from there. Or if not, again, your client account manager is there to answer these questions and make sure you're staying on the right side of the IRS's rules, or if you don't have an account with us and reach out to me to set one up, we can talk about it at that point as well. It's very important when you're self-directing to invest with people you know, build your own network of know, like, and trust. Find your local, in this case, real estate investment group or other type of meetup group for the investment strategies you're interested in, and network within your community, because you never know if you don't vet someone out thoroughly, if a business associate could have otherwise told you, oh, that person's done a deal that went south, or that person's maybe not so trustworthy. Or they could also say, oh, that person's great to work with. I've always generated wonderful returns with that person. So always make sure you're doing your thorough due diligence and know, like, and trust everyone that you're working with. So when we talk about real estate investing, there's a ton of different options. You can invest into single family homes, multifamily homes for either short-term, mid-term, or long-term rentals. You can invest into syndications, which is limited partnership investing, where a general partnership team is actually putting a deal together, raising funds for that deal that come from you as a limited partner, and you don't have any day-to-day responsibilities. You basically vet out the deal, put your money up and subscribe into the deal as a limited partner, let them do all the work on the general partnership team and return funds to you. This is typically called mailbox money, where you just get a check on a monthly or quarterly basis, and then you get a lump sum payout when the deal goes full cycle, meaning they've likely upgraded the property, refinanced it, and maybe sold it to another investor group. You could also do tax deed and lien investing if you're someone that doesn't have a lot of funds in your retirement account and want to get started somewhere in the state space. You could joint venture, where maybe I have cash in my retirement account and a non-disqualified person to me has a piece of property or a piece of raw land, and we're going to partner together, where he's putting the land or the property in, I'm putting the cash in, we're going to upgrade the property and then split the sale proceeds at some sort of determined amount, 60-40, 50-50, whatever it may be, completely up to you to set that joint venture agreement and specifics up. Options contracts, wholesaling, those can definitely be done through a retirement account. I did a webinar about a month or two ago on that. Those strategies, depending on how you're utilizing them, if you're going to scale, may involve the UBIT tax I referenced earlier. If you're actually running a home flipping business or a wholesaling business through your retirement account, depending on the scale that you're doing that at, you may be subject to paying some UBIT tax. And then private lending, so whether you're using your retirement account as a mortgage lender or just doing promissory notes to different individuals, it's up to you to decide if you're going to secure the loan or have it as an unsecured loan. But as long as it's not a disqualified person, you can loan that money out to whomever you want to at whatever interest rate, whatever maturity balloon or anything like that. You completely set the terms with your own self-directed account. So jumping a little bit more into buying real estate for any purpose for that matter, the property is going to be purchased in the name of your retirement account, and all the funds for the transaction have to come out of your retirement account. You are allowed to put an earnest money or an escrow deposit down out of pocket, but when we go to the closing table and actually process the closing transaction, we're going to overfund by the money that you put up out of pocket so that that can be returned to you before the actual closing on the property takes place. So just a quick nuance there, if you found a deal and you really need to act fast and get it under contract, you can do so. We'll have to do an addendum or an amendment to the contract to change the buyer's name from yourself personally to your retirement account, and then we'll be overfunding at closing so that all of the funds for the purchase come out of the retirement account. And then all of the income and expenses moving forward for that property flow through your retirement account as well. So let's just say you buy a property that needs new flooring or a new roof. You need to have enough reserves in your retirement account to pay for that before it starts generating income, because otherwise your hands are going to be tied and you're not able to do any of that labor or upgrades to the property because you can't cover it out of pocket and reimburse yourself out of your retirement account or anything else of that nature. You can make these types of transactions with partners, but it's always important to know that your partnership or ownership in the property is going to be based on the total dollar amount that was brought to the closing table by each party. So if I bring $100,000 to the table and my retirement account brings $100,000 to the table for a $200,000 property, we're going to split that property 50-50, meaning if I have to put a $10,000 roof on it later, I have to come up with $5,000 and my retirement account has to come up with $5,000. If that property generates $2,000 of income, $1,000 comes back into my personal pocket, $1,000 flows into the retirement accounts, account back with Advanta IRA, or however you have it set up for that matter. Expenses, again, need to come out of the retirement account. We have an online portal that you can log into 24/7 and submit a payment request. Those are usually processed on the following day or the same day. Our typical threshold is anything received prior to 12 noon is processed same day. Anything after 12 noon is processed the next business day. With your recurring expenses like utilities, you can have what's called an authorization on file, a payment authorization, so that we automatically, directly from the utility company, receive those bills. As long as you have the reserves in your account, we process them out because you've already pre-authorized us for those specific vendors, whoever they may be. You can also, at your discretion, have an agreement with a property manager where they handle some of that. They also can help source tenants and manage the property itself from, the plumbing issues and things like that. It does cut into your margins, obviously, because you're paying them for their services, but it's something you can certainly do. The property management agreement, keep in mind, is between your retirement account and the property manager, not yourself personally. So if you just go as John Doe and say, I want a property manager for my retirement account on property and sign it yourself, it's not technically legally binding. That needs to come through Advanta. You would forward it to your account manager, and the account manager collects your approval so that we can authorize and execute that on behalf of your retirement account, not yourself as an individual. So repairs and maintenance, again, if you have a property manager, that's kind of out of sight, out of mind. But if you do not, it's important to know that you and your disqualified persons are not allowed to conduct any sweat equity at the property. So you do have to go out and at least get a handyman to do the work. It does not have to be licensed and insured, plumbers, electricians, so forth. You have the discretion to pick who you want to do the labor and work at your property. But with that discretion, you're not allowed to utilize disqualified persons. So yourself, your relatives that I referenced earlier, cannot be painting the walls, changing light bulbs, changing out flooring, or anything of that nature. You set the terms for your tenants, so you completely decide if you want it to be a short-term, a long-term, or even a mid-term agreement. You set the rates and everything like that. Similar to what I mentioned a moment ago, the agreement with the tenant needs to be approved by you, but authorized by Advanta IRA on behalf of your retirement account. So if you, John Doe, sign a tenant agreement or a lease agreement with a potential suitor for the property, legally that's not binding until it's actually executed by Advanta IRA on behalf of your retirement account. Now, there are other strategies like a checkbook LLC to hold the property, which kind of makes it a little bit different depending on how you kind of structure this property deal. But the general scope is that it does have to be approved by the retirement account administrator, who's kind of overseeing and making sure everything, again, falls in line with the IRS's rules. Now, someone just asked a quick question, how do you get paid? You don't get paid. Your retirement account gets paid. So those funds are deposited back to Advanta IRA. Typically, you'd have your tenant make the check or wire ACH payable to your retirement account. Checks are pretty simple. ACHs are wires. We send you to forward along, or if you put us in direct contact with your tenant, send the tenant directly wire or ACH instructions, and they make the payment back into your retirement account. If you physically want to get paid and receive funds, you need to initiate a distribution request out of the account. I think there was a further articulation here. How do you, Advanta, Corey, get paid? Our fee structure is a simple flat rate fee structure. It's the 4th page of our 6-page application packet. Our fees are very competitive in the space. So if you're interested in learning more about exactly what we charge, you could reach out to me directly. I'm happy to email along our fee agreement. I'm not going to say any specific numbers on this recorded webinar because someone may look at it 10, 15 years from now and see that on YouTube. So just reach out to me directly. It's a very competitive fee structure that is easy accessible. You can find it on our website, but it's probably much easier just to email me directly. Someone just asked, any difference with an Airbnb investment? No, you can list your retirement account owned property on Airbnb or VRBO, any of those type of channels. Whatever you want to do to get it rented out is perfectly up to you. So there's no difference. It's just the fact that you're owning this property in your retirement account rather than as an individually owned property that you'd be listing on any of those types of services. So a few other ways to invest into real estate with retirement funds. Again, syndication, I covered that a little bit earlier. Private lending, I also covered, and joint venture, I covered actually. So realistically, I spoke about all three of these in some capacity already, but they're great ways to invest depending on what level of involvement you'd like in the actual investment strategy. Syndication, again, you vet out the deal that a general partnership team puts together. You decide to subscribe at whatever threshold they have. A lot of times they have like a $50,000 minimum, or sometimes 25. Sometimes you may invest $100,000 or $200,000 into a limited partnership syndication. Private lending, you completely set the terms. You could do a $5,000 loan, a $10,000 loan, a $20,000 loan. It's up to you to decide the exact interest rate and maturity timeline and any potential security instruments that you put in place, that if the borrower defaults on the loan, you have the right to collect on those security items. And then joint venture agreeing, I have one asset to bring to the table, my joint venture partner has another asset to bring to the table. We agree on how we're going to structure to split the benefit and proceeds when that transaction goes full cycle. And in a lot of cases, that's I'm bringing cash, someone else is bringing property or construction, something like that, and we're going to split it up in some sort of agreed upon capacity when we sell that property. All right, so I'm going to jump into a few case studies. I believe I've got 4 case studies here for you, and then a question and answer session at the end. So for case study number 1, it's going to be investing into a syndication transaction. So I've got Rebecca, who's got funds in a managed retirement account, and she meets John, who is capital raising for a syndication deal. They meet, they go over the prospectus of the investment. It's going to be a local apartment building, so maybe it's a D class or a C class building, and John and his team thinks that they're going to acquire that property and bring it up to maybe a C plus or a B or maybe even an A class property. So she reviews everything, decides it's a good investment, and then decides she wants to proceed. So what Rebecca needs to do is set up a self-direct account, conduct a custodian to custodian transfer to move the money she plans to invest. And Advanta IRA is going to open the account and submit that transfer request as soon as we get the paperwork to complete the application. And then while we're waiting the funds to come in from the previous company, we're going to go ahead and connect with John, get the subscription paperwork, make sure that's all filled out accurately in the name of Rebecca's retirement account, not herself personally, with the tax ID number for the retirement account, not Rebecca's social security number. She's going to approve everything, and then we're going to execute the transaction as soon as we have the funds in hand, send them over to John and his team. And what that type of transaction looks like as that deal moves forward, typically a preferred distribution is paid out annually, or maybe it's on a quarterly or closer increment than that, but just an example's sake, 8% annually, that's $4,000 a year generated on a $50,000 investment. After the 5th year, the project's refinanced and Rebecca receives a lump sum payout of $65,000. So in total, for 5 years of a $50,000 investment, Rebecca's retirement account earns $35,000. That's 20 total in $4,000, 8% preferred distributions, and a $15,000 lump sum at the end on top of the $50,000 that was returned to her, because that deal flowed very well and was very profitable. This may not be the case with every single deal. Again, it's just a kind of breakdown of what can happen in that type of strategy. So case study number 2 is private lending with your retirement account. So I've got David and Sonia. Sonia is a neighbor of David's, and she's looking to get a coffee shop started. David speaks with her and decides he wants to invest about $100,000 to help her get this coffee shop off the ground. They discuss a few different options as to how to structure it, but ultimately decide that they want to do a $100,000 promissory note for a 10% interest rate and a 12-month maturity. So Sonia needs some much needed money to help get her coffee shop up and running. And David basically generates $10,000 in 12 months from that investment. And again, in part helps his community, gets another local coffee shop up in the community, supporting local businesses, supporting a friend or a neighbor. It's a great thing to do. Now, this investment could have also been structured with a security instrument where if Sonia were to have defaulted on the loan, David can go collect a specific tangible asset from her. But maybe he trusted her enough and knew her enough that he didn't necessarily need to do a security instrument in this case. Case study number 3, purchasing rental real estate with your retirement account. So I've got John, who's got a 401k from a previous employer, and he wants to purchase a duplex. So John's going to open and fund a self-direct account with a direct rollover. He's going to make an offer to purchase a property and the proper purchase authorization paperwork. Advanta IRA is going to get the account set up, work with the closing agency to make sure the proper titling is on all the documents, execute the transaction and send the funds to the closing so that the retirement account that has been set up for John ultimately purchases this duplex directly. Now, moving forward, the property is rented out at $1,500 a month for 2 years. That's $36,000 total in rental income. Then John sells that property that he initially purchased for $200,000 after 2 years for $275,000. So no taxes or capital gains specifically are paid on the $111,000 of profit generated, and John now has $311,000 to invest in the next deal or potential multiple deals, since that's enough to maybe buy 2 properties, maybe a little bit less than a $200,000 property, obviously, but he could split that up. Now, what I don't mention here in the bullet points is that there may have been expenses that come up. So out of that $111,000 profit realized, maybe 15 or 20 of it is taken out because a roof had to be put on or general maintenance, plumbing, anything had to be done at the property. So keep that in mind. If you have exactly 200,000, you don't want to go buy a $200,000 property just in case you don't have enough reserves in the account by the time one of those major expenses comes up and you're waiting on income to hit the account so you can even get something fixed or updated or upgraded at the property. All right, the next case study here is making a purchase for a fix and flip. So in this case, David again, he's going to make an offer to purchase a distressed property in his community for $150,000, and he expects about $25,000 in upgrade costs. Because this is a cash deal, he can close pretty quickly with his retirement account and start rehabbing the project. He knows that he's not allowed to do any sweat equity at the property, even though it doesn't have to be licensed and insured individuals, it has to be a third party. So he hires all the contractors, schedules all the work, makes sure he reviews it upon completion, and processes the payment directly through his retirement account. Again, what does David do and what does Advanta IRA do? David finds the property, he opens a self-direct account, conducts the rollover to fund the account, coordinates all the contractors for the rehab work, and approves all the payments from Advanta to go out for the contractors. Advanta executes the real estate transaction, processes the payments to vendors when we're told to do so, and then facilitates the closing transaction when David turns around and sells this property. Quick example here. David invested a total of $175,000 into this property. That was $150 to buy it, $25 to upgrade it, and then he sells that property for $225,000. That's $50,000 of profit generated, which can either be tax deferred or tax free, depending if it was a traditional or a Roth account he utilized. And as I mentioned earlier, this may come into play with UBIT tax. If David is doing 10 fix and flips in a 12-month calendar year, that kind of constitutes running a flipping business through his retirement account. So he may want to speak with his CPA or tax preparer and do UBIT tax filing. Now, there's no black and white rule from the IRS as to what number constitutes running a business. So it's always up to you to kind of speak with the right person or team and figure out if your needs and your use of the account are going to necessitate UBIT. If you're doing 1 or 2, that's typically not an issue. It's when you're getting upwards of 5, 6, 7 in a calendar year. So it's real easy to get a self-direct account opened. Our application, Like I said earlier, it's about 6 pages, takes about 15 minutes to complete it. I can walk you through it over the phone or have a phone call ahead of time with you to make sure your strategy and your intents fall within the IRS rules, or maybe redirect you a little bit based on those rules as to what you can do, similarly aligned with what you may have thought you could do. Getting the account funded is not triggering any taxable events. It's very quick. We usually get accounts funded in about a week to a week and a half. And then finding your investment and making the investment is a pretty quick process as well. Our account management team can get a transaction from the time it hits their inbox as, hey, I want to invest into XYZ, to processed and funds sent out for the investment within a few business days. So it's a real quick, simple, sweet process that we try to put together for you here at Advanta IRA. We have a lot of educational content like this webinar. We do 2 of these webinars a week, typically every Tuesday and Thursday. We bring on various guest speakers and have various different topics. You could find the full catalog of previous webinars on our YouTube page. Just go to YouTube and type in Advanta IRA. We have a podcast called the Alternative Investing Advantage Podcast, hosted by my colleague Alex Perney, where he brings on guest speakers as well and has more of an informal conversation with them about various investment strategies and different things. And we have a blog also if you're interested in kind of some of the industry nerdy type news, if you will. We just went through an election cycle. The last election cycle, there was some legislation that was being tossed around that was going to actually restrict some of the ways that you could utilize retirement accounts. And we posted blogs about that. We started a change.org petition, and we actually helped get that language removed from the legislation that was actually passed, so that the retirement account investors' opportunities and rights were not infringed upon in that case scenario. All right, so I'll give you guys just a few minutes to ask any final questions or anything that you may have. I just see one new question on the screen from when I addressed the questions box last. So I'll go ahead and address that while I get my contact information back on the screen. And if nothing else comes up, we will go ahead and conclude here shortly. This question reads, on a fix and flip, can you act as the general contractor? Pseudo. You can pseudo act as the general contractor. You're allowed to coordinate those vendors. You're not allowed to do any actual sweat equity. So the most you can do in a general contractor capacity is coordination and inspecting the work prior to approving payments to go out. So that's to say, oh, I can find what masonry person I want to work with, what glass person I want to work with, what roofers I want to work with. I can make sure they don't get paid before I'm inspecting the work on site and on hand. You can't pay yourself for inspecting that work or doing anything, and you can't lift a finger from a sweat equity standpoint. So not necessarily a true general contractor, but like I said, pseudo general contracting. All right, I am not seeing any other questions come up, so I'll go ahead and conclude the webinar now. One just popped up right when I said that. Please take down my contact information. Feel free to reach out to me if I can answer or assist you with anything further. I'm also happy to share a PDF version of today's presentation. If you just email me for the slide deck, I'm happy to share that with you. The recording will be emailed out to everyone that's here live or signed up for this webinar by typically the next business day or so, or you could find it on our YouTube page in about the same time frame. Do you find real estate investment opportunities, or is that the responsibility of the account holder? That is the responsibility of the account holder. If you were not here at the very beginning of the presentation, we're not a fiduciary or a financial advisor. So we are strictly prohibited from providing any tax advice, legal advice, or financial advice, which also constitutes pointing you in the direction of a specific opportunity or a specific investment provider. Having said that, we do have a once-a-month virtual networking call. It's called Pitch, Promote, and Prosper. We actually just hosted it last week. It's in the middle of the month for next month because of the Christmas and New Year's holidays. So that is on a Friday. It's a 12 p.m. Eastern Time, 1 p.m. Zoom call, and everyone on the call gets a chance to say who they are and either what they're looking for to invest into or what they have to offer for investors. You put your contact information in the chat and network free and thoroughly from there. Again, doing your own due diligence, but it's a group of like-minded individuals such as yourself that are either looking for deals or have deals to offer. We try to keep it very collaborative. And again, it's just a chance for you to meet other people that are either clients of ours or have worked with clients of ours in the past that have deals or have money and are looking to find the next thing in a social collaborative network. So pitch, promote, prosper. You can find it on the events tab on our website and sign up for the next one in the middle of December. All right, well, thank you all for your time and energy for this presentation today. I hope you walk away with some value, and I look forward to seeing you all next time. Have a great rest of your day.